Ever thought about the ripple effect of an earnings release on CFD trading? Imagine the financial world as a giant ocean. Each company, a substantial entity within this ocean, releases periodic financial results, known as earnings releases. Just as a stone creates ripples when thrown into water, these earnings releases can cause significant waves in the world of contract for difference, or CFD trading. An earnings release is essentially a public statement of a company's financial performance over a specific period, usually a quarter or a year. It's a report card of sorts, revealing key financial metrics like revenue, profit, earnings per share, and other relevant figures. These numbers, these ripples, can have a significant impact on the price of the underlying asset, and by extension the corresponding CFD value. Now, why is this important? Well, CFDs are a type of derivative trading where you speculate on the rising or falling prices of fast-moving global financial markets such as shares, indices, commodities, currencies, and treasuries. Because the value of a CFD is derived from the price of the underlying asset, any significant changes in that price can affect the CFD's value. Think of it this way. Before an earnings release, there's a sense of anticipation, much like the calm before a storm. Traders and investors are speculating, positioning themselves based on their expectations of the company's performance. It's a game of educated guesses, where the stakes can be high. The moment the earnings release hits the market, it's like the stone being thrown into the water. The market reacts, the price of the underlying asset moves, and the ripples are felt throughout the CFD trading world. If the earnings are better than expected, the asset's price tends to rise, and if they're worse, it tends to fall. And just like that, the price of the CFD adjusts accordingly. If the price of the underlying asset goes up, the buyer of the CFD makes a profit, while the seller suffers a loss, and vice versa. As we can see, the impact of earnings releases on CFD trading is profound. Before the storm, there is always a calm. The same applies to the trading world. As we inch closer to a company's earnings release, the air gets thick with anticipation and speculation. This is the period where traders and investors huddle around their screens, gauging the financial health of the company and formulating strategies based on their predictions. The anticipation phase can be likened to the calm before a storm, a period of relative tranquility before the flurry of activity that follows the announcement. It's a time of great excitement and anxiety, where every bit of information is scrutinized and every rumor is analyzed. The market buzzes with whispers and hushed conversations, all revolving around the big question: what will the earnings release reveal? Now, speculation plays a critical role in this phase. It's a game of expectations. Traders and investors form hypotheses about the company's financial performance, and these hypotheses drive their trading decisions. Some may expect a positive earnings report, leading to a surge in buying activity. Others may anticipate a negative outcome, triggering a sell-off. These varied expectations contribute to the volatility of the asset's price, causing it to fluctuate even before the earnings are announced. In some cases, institutional brokers who have the ability to trade during the pre-market hours add to the speculation. They position themselves based on their predictions, further influencing the asset's price movement. But remember, speculation is just that. Speculation. It isn't a guarantee of what's to come. It's a calculated risk, not a gamble, but based on research and intuition, and sometimes even a bit of luck. As the clock ticks closer to the earnings release, the anticipation builds, the speculation intensifies, and the market braces itself for the impact. It's a thrilling period, a high-stakes game of wait and see, where fortunes can be made or lost in an instant. The speculation and anticipation set the stage for what's about to unfold. As we move forward, let's delve into the next phase, the earnings release itself, and how it can set the wheels of the market in motion. The moment has arrived. The company releases its earnings report. This is the moment traders have been waiting for. The earnings release, a key event that can significantly impact the price of the underlying asset, and in turn, the corresponding CFD. The earnings release is essentially a financial report card for the company. It typically includes a range of key financial metrics such as revenue, net income, and earnings per share, or EPS. These are the numbers that investors and traders keenly watch, as they provide a snapshot of the company's financial health and performance over the reporting period. Some companies may also provide guidance for future performance, offering a glimpse into what might be ahead. This can further influence market sentiment and price movements. So in essence, the earnings release is a pivotal moment in the financial calendar. It's a time when numbers speak louder than words, and those numbers can trigger significant market movements. The earnings release. It's like a report card for the company's financial performance. What follows the earnings release is the market's reaction. It's like a ripple effect. Now let's paint a picture. The company's earnings release hits the newswire. Investors, traders, analysts, everyone's eyes are glued to the screen, scanning the report, comparing the actual figures with their expectations. The market is a living, breathing entity, and it responds to the earnings release almost instantaneously. Just like a stone dropped in a pond creates ripples, the earnings release sends waves through the market. These waves are the price changes of the underlying asset. If the earnings report is better than expected, the price of the underlying asset, be it a stock, an index, or a commodity, usually goes up. On the flip side, if the earnings report falls short of expectations, the price typically drops. But it's not just about whether the company met, exceeded, or missed the earnings estimates. It's also about the company's guidance for the future, any major business developments, or changes in the broader economic landscape. All these factors can influence the market's reaction and the subsequent price changes. The price changes can be dramatic, especially for companies with a lot of uncertainties or high expectations. A significantly better or worse than expected earnings report can lead to a large price swing. But remember, the market is a complex beast. Sometimes, even when a company reports strong earnings, its stock price might fall. This can happen if investors had even higher expectations, or if there's some other negative news overshadowing the good earnings report. In essence, the market's reaction to the earnings release is a reflection of the collective sentiment of all the market participants. It's a real-time voting machine, where every buy and sell order represents a vote on the company's financial performance and future prospects. The market has spoken. The price of the underlying asset adjusts to reflect the company's financial performance. As the underlying asset's price changes, so does the corresponding CFD's price. This is a fundamental aspect of contracts for difference, or CFDs. These financial instruments derive their value directly from the price of the underlying asset, be it a share, index, or commodity. So when a company releases its earnings report and the market reacts, causing the asset price to shift, the CFD price adjusts in tandem. If the asset price goes up, the buyer of the CFD stands to make a profit, while the seller is at a loss. Conversely, if the asset price goes down, the seller of the CFD profits, while the buyer incurs a loss. It's a dynamic and immediate process, reflecting the live market conditions. This real-time adjustment of the CFD price is what makes trading them so intriguing and potentially rewarding for traders. The CFD price mirrors the underlying asset's price. It's a mirror reflection. With volatility comes opportunity. That's the mantra ringing in the ears of savvy CFD traders around the world. As we've discussed, the release of a company's financial results can significantly jolt the price of the underlying asset. And when the price moves, opportunities for trading arise. Increased volatility following an earnings release can make the market a trader's playground. Be it a bullish surge or a bearish slump, the swift price shifts can be capitalized upon by those quick on their feet. If you're on the right side of the trade, the potential for profit can be substantial. But remember, while volatility can be a trader's best friend, it can also be a formidable foe. The same rapid price swings that can lead to gains can also result in losses. Therefore, risk management should never take a back seat. Earnings releases. They're not just about numbers, they're about opportunities. Let's take a moment to reflect on what we've learned. Earning releases, the financial report cards of companies, significantly influence the price of the underlying asset. This, in turn, impacts the price of the corresponding contract for difference, or CFD. Before an earning release, the market buzzes with anticipation and speculation, causing heightened volatility. These fluctuations present opportunities for CFD traders. When the earning release is published, it reveals key financial metrics. The market's response to this information, compared against its expectations, drives the price of the underlying asset. Remember, the price of a CFD mirrors the price of the underlying asset. So, if the asset's price rises in response to positive earnings, the CFD buyer stands to profit, while the seller may face a loss, and vice versa. Earnings releases. They're a key part of the trading world, influencing not just the underlying asset's price but also the corresponding CFD's price.